Hi everyone, a very good evening to you. Welcome to my channel. It's your friend and brother Sydney. Today we shall be discussing support and resistance. Before we delve into the topic of today, just to remind us that during the last class we spoke about very important FX signals. We talked about the engulfing pin bar, the bearish and the bullish. We also discussed the evening and the morning star. We also took time to discuss market structure and trending markets. So today I'm going to be shedding more light on support and resistance. But before I go into support and resistance, I want to highlight trending markets. Now, trending markets are markets that consist of two substantive moves. You have an impulsive move as well as the retracement move. Now, in an uptrend, you want to be a buyer at the beginning of an impulsive move, because just as being displayed on your screen, you discover that going from higher highs to from higher lows to higher highs, I beg your pardon. So you find that it gets to a point where it has this impulsive move, and the impulsive move actually takes it to the next higher high, and after it gets to the higher high, it retraces, and retracement means it tries to do like a minor sell for some maybe 5-10 minutes, and then it pushes up once again. Another impulsive move takes it to the next possible resistance level. I'm going to explain that anyway in the next few minutes. So you see, it goes from impulsive move, retraces a bit, and takes another impulsive move upwards, retraces a bit and takes another one. That's a typical uptrend. Now, in an uptrend, you want to be a buyer because, of course, it's the value of that pair is appreciating with time. So as an experienced trader, you want to actually begin your trade once the impulsive move starts, just like you're seeing on your screen. You want to be in the market as a buyer once the impulsive move starts, and once you are in the market, you take out your profit when you get to the possible retracement move. Of course, you don't want to be a buyer at the retracement move in an uptrend, because when it's trying to retrace its step a bit, it's like it's going to depreciate in value just for very few moments and takes off the next impulsive move. So if you're able to understand what an impulsive move and a retracement move is all about, then it helps you position your trades well for better probability of success. That is for an uptrend. For a downtrend, you see that, just like we discussed in the previous class, it goes from lower highs to lower lows, makes lower lows, lower highs, and it keeps going down that way. So you see the impulsive move, when it gets the first impulsive move, it goes downwards. Unlike the uptrend, impulsive move shoots up, increases in price, retraces a bit, and shoots up again. But in a downward trend, the impulsive move moves in a downward triggering downward move, then retraces. Retracement in the downtrend is like it moves up a bit, hits another impulsive move downwards, retraces a bit and hits another one. So it goes in that series of lower highs and lower lows. And in this case, you want to be a seller in a downtrend because the price of that commodity is depreciating with time. So once it moves, it takes that impulsive move. You want to be in the market at the beginning of that impulsive move. You want to be a seller at the beginning of that impulsive move. And when it gets to the retracement move, retracement in this context, like it's trying to retrace upwards a bit for very few moments before it takes the next impulsive move downwards. Then at the beginning of the retracement move, you want to leave the market. okay, and wait a bit. When he hits an impulse, when he tries to make another impulsive move, you go in there and then you take your profit, you leave during the next retracement move. That is exactly what it's trending markets all about, how you're able to trade trending markets. Now that brings us to support and resistance. You know, ask yourself, what is support and what is resistance? Support and resistance are points or areas in the chart where the price tends to make a reversal. Okay, perhaps if you've got like a downtrend and after some time it makes a reversal, like you've got, just like I discussed in the last class, you're having a downtrend and maybe you find some pin bar, right, a bullish pin bar, or you have a bullish engulfing bar. What does it tell you? Just like I discussed, it's a possible reversal signal. So at that point it's trying to reverse. Perhaps it had attained a support level at that point and it's trying to. So support and resistances are points in the chart where prices tend to reverse. You're going to understand it as that. Okay, so these support and resistance levels are defined by a couple of swing points. Now, just like has been displayed on your screen, in an uptrend, the previous swing point acts as a support to that move, and in a downtrend, the previous swing point acts as a resistance in that move. Now, professional traders leverage on trend lines to be able to identify the beginning of an impulsive move. At that point they should enter the market. They should take a trade. You don't just go into the market taking a trade, otherwise you're going to lose your funds. So your ability to effectively draw a trend line is going to help you identify the beginning of a possible impulsive move. So how do you draw a trend line? All you just have to do is to connect those swing points together. Sometimes they move like if you're able to draw them, connect those swing points together, you find out that they assume a linear shape, and by the time you see it connecting, sometimes you want to connect 4 swing points, 5 swing points, 6 swing points, then you're able to understand the shape of that move, and then by so doing you're going to know when exactly to take your next trade, be it a buying opportunity, presenting you with a buying opportunity or a selling opportunity. So I hope that's covered for support and resistance. Now, okay, recently a question was shared in our community by one of our folks. It was like, what's going to happen to gold USD, SAU USD pair in the nearest future, bearing in mind what is actually happening in our society today, that I should share my thoughts. I'm going to tell you for free, for those of us that don't really understand price action as regards to gold. There is this inverse relationship between gold and the USD. Of course, when the price of USD goes up, when the US yields tend to boom, of course it depreciates the price of gold. But then one of the major boosts to gold is the fact that gold is seen as a safe haven asset. And when you're talking about safe haven asset, I mean safe haven assets are assets that tend to regain their value in event of high inflation or in geopolitical tension. So regardless of the outcome of inflation, regardless of the depreciating effect of inflation, gold tends to retain its value. And that's exactly why big investors tend to diversify their portfolio. They tend to buy more gold to hedge against inflation. That's the word. It's like a hedge against inflation. So what are we saying? Big buyers in the market, like the central bankers, are putting up huge reserves of gold in their portfolio. And recently, China has added almost 160,000 ounces to their gold reserve, and that's exactly what most of our central bankers do. And as an investor, you want to put your money where it's not going to dip, rather it's going to appreciate in value, and that's exactly why gold for some time has looked like it's been performing well. Like I said in a couple of minutes ago, there's this inverse relationship between gold and USD. Once the price of the USD goes up, gold tends to depreciate in value, and vice versa. And one of the major boosts to the USD is the fact that there is this high inflation. If inflation tends to go up, the price of the value of the USD goes up as well. If inflation goes down, the price of USD goes down. Now, the Fed, the authority that is saddled with the responsibility of fighting inflation in the US, have embarked on what we call quantitative tightening for some years now. So quantitative tightening, that means they are trying to fight inflation by tightening their monetary policies. And what has that resulted to? It has boosted the USD. It has made lending very, very expensive. You're going to pay more on your mortgage. You're going to pay more on assets you had borrowed monies to buy. So you tend to pay more on financed assets. So to that effect, and just like I said before, once the USD softens, the prices of gold tend to increase. So what has happened recently? The price of gold has surged because there has been this anticipation that the Fed shall very soon begin to cut rates, and once they cut rates, of course it's an indication that they are satisfied with the level of inflation. But going forward, with the geopolitical risk in the Middle East, with the Russia-Ukraine tension, and with the BRICS ideology of diversifying away from the USD, most of these countries are fed up with the USD, and of course it's putting pressure on the dollar. So to that effect, most central bankers, most economies are beginning to look at gold as a potential means of storing value, and that's exactly why the price of gold has witnessed a substantial surge in the past few weeks. Speculators still also believe that the prices will still go more than that. So as a trader, what you want to do at this moment is to actually position yourself well in the market. Wait for the next impulsive upwards move. Of course, we know it has been an overall bullish momentum. It has been in an uptrend. So you want to wait for the next retracement move to happen, and at the beginning of the next impulsive move, you take your trade. And that's exactly how to trade such markets. So also you need to pay attention to the news, especially the news from the Middle East. Israel and Iran, all of those tend to affect the prices of gold. When there are tensions like this, geopolitical tensions all over the world, investors rush to get out their monies from the bank and invest in precious or safe haven assets like gold, silver, platinum, and the rest of them. So overall, people still tend to be bullish in nature in gold. So that brings us to the end of today's class. I hope you enjoyed our assignment today. If you actually did do well, to like, comment, and share our videos so that you get them as soon as they are being published. So until then, do have yourself a wonderful week.